Good morning, folks. OBS is challenging me this morning again. Okay, if you are a user on X, or what was formerly known as Twitter, and you follow me there, if you give me a 5x5, that'll tell me that you guys can hear me fine. Thank you so much. Thank you for that. Appreciate it. Okay, let's get this going. So I purposely left myself a void of reading any price action on Sunday. This is my first time, with the exception of just toggling to the weekly chart. So I've only looked at the charts long enough to see the time frame change. I haven't looked at any kind of levels. The absence of holding a previous week's bias. If I could come into a live stream like that, I'm trying to accomplish the same thing I believe that Caleb would have. So in other words, it's easy for me to spend about 20-30 minutes in the evening time with the London session, maybe 20-30 minutes in the Asian session when it opened up last night, just getting the weekly opening gap and then turning the charts off and just letting overnight take whatever action it wants to take, and then coming into the morning pre-market. Pre-market is, I like to trade those days when there's a Powell speech, when there's FOMC. I like to trade early in the day because the price action tends to be a little bit more cleaner. And what I mean by cleaner, it's a little bit more obvious in terms of what it wants to reach for. It's far less likely to be like a seek and destroy or a high resistance liquidity profile, because there's a lot of professionals in the market trying to get in and take something early on and let everyone else gamble after or during or ahead of a Powell speech. Typically, the days that have the Fed chair speaking, right before he starts, or she, when there was a lady that used to be a Fed chair, whenever they would speak, leading up to that, the market would tend to be a little bit more fickle, a little bit more challenging. And in my opinion, they were better left to the novice traders, someone that just wants to believe they can gamble and get lucky. But on days that your Fed chair is speaking and it's in the afternoon, or if it's really early, like say it's like a 10 o'clock, or even a 9:30 or 9:15 or 9:45 speech, anything, okay, prior to 9 o'clock, in my opinion, is pre-market, because the opening range is 9:30 to 10 o'clock during that first 30 minutes trading. If there's a Fed chairman testimony where they're talking, any time within that 9 o'clock to 10 o'clock hour, you want to be trading before 8 o'clock in the morning. So you want to have that in your notes. I'll talk more about those things in the book, but I just want to give you a little bit of like a tip my hand to you, give you some hints. Today, if you look at the economic calendar, you'll notice that there is one medium impact news event. That's the Chicago PMI number at 9:45. So that's 15 minutes after the opening bell. So that's fine. That'll help fuel some of the first 30 minutes trading. My counsel to my son is, because it's a 9:45 medium impact news driver, he has to sit still and wait until 10 o'clock. So he'll let that news driver come into the marketplace, let traders either get canceled out, stopped out, or get kicked into an idea based on what they see at the 9:45 news event. He's not trying to predict the delivery of price. He's letting that first 15 minutes pass. Okay, so that's like the minimum criteria for anything that comes after a high impact or medium impact news driver. Wait 15 minutes. If you're trying to trade right on the release of that news and it's under 15 minutes, your chances are you're probably in a rush and you're in a hurry to do something you probably aren't equipped to trade with. There's plenty of other opportunities to get in, as you'll see in the rest of the mentorship before we close it down this year. There's lots of ways to get into a move. So uh, the pre-market session is anything before 9 o'clock in the morning. We have a Fed chairman testimony today, but it's in the afternoon. So you can trade all the way up until the opening bell. 7 o'clock in the morning starts it, and that's 7 o'clock in the morning Eastern time. So whatever the local time is in New York, always have your clock set to that, and especially your trading view charts. Because if you don't have them toggled to New York time, if it's not toggled there, everything that I'm teaching, you're not going to be able to follow correctly. If you're using your local time, it won't work. So sitting down with the charts, this is what I do. Okay, this is exactly what I do on Sunday. So I deferred everything that I would normally do then. I'm doing it now. Now, admittedly, I'm doing it a little bit late because I want to come into the live stream knowing next to nothing in terms of a bias. I don't have any kind of preconceived ideas about what I want to see in the charts. I want to see what the chart looks like as I sit down with it. So this is basically pantomiming the closest thing I can. I can't forget what I already know, right? But for the sake of presenting it for my son, and also to try to illustrate that, you know, it only takes a few minutes to ascertain what it is that you want to focus on. And now we're going to go through it. So this gap up here, we talked about this throughout the 2024 mentorship. We talked about the volume imbalance here. In the September contract, I told you that was about as far as I could see for the year for that contract. It went just a little bit above that, and then when we rolled over. If we looked at the on the daily chart, right now I'm looking at the weekly, but the weekly has this imbalance up here. So we've had that trade too, and we have just a few more weeks to get to the U.S. election. And I want to give the market the opportunity to explore lower prices. And what would that look like? Well, we already have what would be the start of a potential, I'm not saying that it is, this could be a potential turning point. So I would like to see if we can make an attempt to start breaking down. I don't want to predict or time the high in the marketplace, but I'm affording myself at least going in because I'm assuming that it's a Sunday. The weekend's passed. And now I'm going to look at what I want to try to see in price action, formulate some kind of a game plan. I like the idea of entertaining the likelihood of trading down into this gap here this week. So that's this right here. So basically what I'm doing, I'm giving you a soup to nuts breakdown of what I do on the weekend. Sometimes I'll do it on a Friday, and then I'll have notes about what I expect to see based on a higher opening on Sunday's gap, or a lower opening gap, or a lack of a gap. So I'll flesh out scenarios, and I'll talk more about that in the book because it's not important. Right now I'm giving you actionable points. That's this whole week I'm giving you something to strip it down, remove all of the moving parts and say, okay, I need something to provide myself a way of determining a bias. And then I have to also learn how to frame a narrative why the market should behave a certain way. And then what model am I going to use? And what time of day am I going to trade? And how am I going to enter the trade? And how will I place my stop loss? How will I take a first partial? When will I move my stop loss? When will I be content and it trades to my terminus, and then I stop trading for that session or that day and then go back in the next day? That's what we're doing this week. Like, this is boot camp for getting out there and using my concept correctly, streamlined. It's not fluffed up with everything you possibly learn from my YouTube channel. It's literally going in and saying, this is how you make money. This is how you go in and you look for setups that form every single day. You go in looking for this same repeating recipe. Sometimes it isn't going to give it to you. Sometimes you'll think it's there, you'll execute on it, and you'll lose. That's the reality of it. I don't have a model that's 100%. I'm not going to teach you 100%. No one else is going to teach you 100% either. So just relax and accept the fact that uncertainty is something you need to embrace. But you can start to strip away some of that stuff by fleshing out a model that has sound logic in. And what we're looking at is we're up here, we traded to a premium relative to the weekly chart last week, and then now we're in this week's present candlestick. The inefficiency on the weekly chart is this candle right here. This week's high, that week's low. This individual candlestick only has buy side delivery, that means movement higher. And it would be reasonable to anticipate the market wanting to go and explore that's weird. This low. Okay. And for annotation purposes, Caleb, what you want to do is when you're annotating on a higher time frame chart, anything you put on your chart on a higher time frame, because you're going to be working on the lower time frames for entries, exits, and management of a trade, you want to annotate that. So this is September 23rd weekly low. So that way when you go into the lower time frame charts, when this line appears over here on the right hand side towards the price axis of the chart, this is your time axis at the bottom, this will always give you a reference point as to what you're looking at. Because if you start laying down lines on your chart and you don't annotate them, you don't tell yourself what they are, they're meaningless then. They're distractions. So you want to be organized with your annotations, and then obviously if it makes the effort to get down into this inefficiency, this one here, September 9th. So the week of September 23rd and September 9th, respectively, shown here. And this is the weekly high for that week. Short, sweet, and easy. Now you can go as far as going into adding the consequent encroachment of that, and I'll do it now just to show you, Caleb. Take the low of it and the high and the midpoint. Take the quadrants off. So 883 and a quarter. $883 and a quarter, $883 and a quarter. Okay, and just anchor it inside that candle there. You can label it. There it is. Okay. This wick here, you can annotate that with consequent encroachment as well, and this one. But we're going to leave that off today, but you can do that for your own charts. And then the daily chart. So now we can start refining a little bit more. We have this little gap in here of volume imbalance here and a volume imbalance there. Whenever there's consecutive volume imbalances with just one single candle like that, just do the entire range. It makes it very easy. You'll see the inefficiencies just the same as you would if you just done them individually. So what that looks like is this. And since it's a premium array, you want to have some kind of a hue or color that helps you, not too much. Like that's enough for me to notice it. You can do whatever you want to do in your charts, but I'm just giving you the idea how I'm going to be able to refer to it. I don't keep this stuff on my chart. As you can see, when I put it on there, it's very distracting and disorienting me sometimes. I know what I'm looking at just by the candlestick, and it's actually harder for me to teach it and describe it real time than it is to just simply do it. So, and you'll know what that means when you start getting better at it. But we have that volume imbalance here. That is 2 consecutive volume balances, but only separated by 1 candlestick. Usually you only see something like this candlestick body to that candlestick body, and that's a volume imbalance. But there's one immediately to the left of that too. So just to encompass the entire range there. It's fine because this is actually an indecisive candle. It is basically all, but not, it's not that important. The more important factor is this and this. Okay, so just disregard this one. Trust me in that. Okay, you'll see what it means when we start looking at lower prices. All right, so now you should already notice that there is 2 lows down here that are real close to one another, right? So when we drop down to, I'm going to skip entirely over 4-hour chart because it's not necessary. If I was swing trading, or if I was trading for like the entirety of the weekly range, I would drop down to the 4-hour and do the same type of thing, looking for specific PD arrays, things that would be impactful for me. But because I'm not trying to swing trade, I'm not trying to do anything except for session trade, or at the very most, that's not appropriate, is it? At the very least, I'm trying to do just a session trade or scalp, but up to the daily range. And that can be afforded to you by simply looking at the hourly chart. So we're going to do a 60-minute chart now. Okay. And you see this big wick right here? This is a level. I'm literally teaching you right now. This is what I write on my notepad. You guys keep asking. I go through the charts and I write down all the things that I'm doing right here. Any wicks that are at lows or highs or in close proximity to market price, I annotate those consequent encroachment levels. And if it's something that's a discount, like this would be here relative to where we're at here, this is where the market price is right now, 20,152.5. Let me add the there you go. It bothers me when I don't see that thing there. This wick is lower than the current market price. So that means that this is a discount wick. Whereas something like this wick would be a premium wick because it's above current market price. Okay. If you're not looking at price in relative terms to premium to discount, you're absolutely doing it wrong. Okay. You're absolutely, I don't care what young man this makes a YouTube video and says, you don't need this, you don't need that. Every single high probability short is always entered, whether you use my stuff or not. If it's worked, it's because it was in a premium and it's moved to a discount. Every single 100% strike rate, every single time a long trade that was profitable in your hands or anyone else's hands was because it left a discount and traded to a premium. Absolutely 100%. It never misses. It's just like a partial profit. It never misses. It never loses. It's 100% strike rate. So for anyone that's telling you, don't worry about looking at premium to discount, they're a fucking clown, and stop watching them because they literally are trying to reinvent something and they're taking your eyesight away from the things that matter most. If you can't frame the basis of your short that it's inside of a premium, you're hopeless. If you can't frame your long on the basis of a discount, you're hopeless. You're literally asking to lose money. You might as well just go outside, find the first person you see, and just give them your money. It's more charitable than you just going out there and giving it to people that know better and you don't. Okay, so I mean that entirely. So this is another level here. I'm writing them down as we go. So this level here, okay, so that's consequent encroachment there, and This will be annotated as an hourly. I abbreviate, I just put like a 60M CE, and it's because it's lower, I put a little tiny D next to it, so it tells me it's a discount. So it's 60-minute discount WIC CE. That's your definition, so that way you understand what it is, but I just told you how I write on my notepad. And there it is. So, all right, yeah. Huh. I double up then. How'd that happen? OCD's flaring. Okay. Now, I go through the daily chart. I like the idea that we cleared this high here. I like the idea that we went into this inefficiency here. This is sell side and bounce, buy side efficiency. I love the fact that we traded back up to change the state of delivery, which is my order block theory, and it's the opening price of the up close candle right here. So that is a really nice delivery there. And I don't know why every time I'm drawing these trend lines, it's shooting to the left. And I have no idea why it's doing that. Yeah, I don't know what's going on there. It's weird. Let me know in Twitter if TradingView is acting wonky for you. But I don't want to do a ray because this is going to drive me nuts. It's not important. But that opening price there and this high, that being together is that's nice. What I want to see, admittedly already, is I want to see price try to go lower this morning. Okay, so my bias is bearish. I want to see something that I can frame as a narrative now to go lower. So what would that be? Well, we already noticed on the daily chart there were some relative equal lows that I spotted, but can we see them on the lower time frames where it makes sense? So we can drop down from the hourly chart now to a 15-minute time frame. Now, obviously, it's taking me more time talking and teaching you why I'm doing what I'm doing than actually just doing it. So it literally takes a few minutes just to go through the time frames, break them down, look for the levels, and there it is. It's the obvious things that you're looking for. If it's not obvious, you're probably straining to make it work. Okay, if it doesn't jump off of the chart at you, chances are you're probably making more of it than it really is. And I mean that. You'll see in your own experience that the more you try to push and push and push like a fine-tooth comb, go through everything, you don't need to do that, especially on these higher time frame charts. Like 1 hour for me is it's a higher time frame. Like there's a lot of stuff going on in every one of these individual candlesticks on a 15-second chart, and every one of these individual 1 hour charts is like a daily range for me. I can trade a 15 and 5-second chart and run circles around most everything else out there and just trade inside one of these 1 hour candles. And how many candles do you have in a daily session? So you can see how fast velocity kicks in. So while it's not important for you to be able to do that yet, Caleb, but you will if you stick with it and you want to do that. Dad will absolutely love teaching that to you, but you have to start like here first. So we'll drop down to an hourly chart to a 15-minute time frame. And here's the business from, here's Friday and then Sunday. So the only thing I did last night at 6 o'clock was annotate the weekly opening gap, and then I turned the charts off. So this is the first time I've seen a 15-minute time frame. And looking at the lows here, notice how that low has that lower low to the right of it. And then this low has that low lower than the one here. And this low has the lower low here to the right of it. And now this low has been breached by this. So we don't see any kind of relative equal lows here. We see what? The market keep probing lower, keep probing lower, keep probing lower. Remember what we have later in the afternoon, that Fed Chair Powell speaking. We have a little bit of likely volatility coming in. And then what we'll have is what? some kind of Judas swing, right? Between 9:45 and 10 o'clock in the morning. I'm anticipating in my mind, I'm thinking, okay, without that 9:45 news driver, the Chicago PMI news report, that's what I'm referring to. So if you look at your economic calendar, you can see that on forexfactory.com. That's one I used a lot when I was teaching predominantly just the Forex market. And everything I'm doing here is what you do in Forex too, folks. I know you guys are barking and saying, please do Forex, please do Forex. It's the same thing. Everything I'm doing here is the same thing you're going to do in your Forex pairs and with the dollar index. The only thing is with Forex, you got to go one step further and do it on the dollar index too. So everything should be mirrored. Anything you see in the dollar index, you should see the opposite in your pound dollar or your euro dollar or your dollar yen or whatever pair you're trading. You have to at least refer to the dollar index to get a full panoramic view if you're trading Forex. In futures, we don't have to worry about that. Notice I haven't even brought in, I very rarely even referred to the SMT studies. I think I probably pulled up maybe 2 or 3 times the entirety of this mentorship in 2024 because I need my son to look at the very minimum things initially. If I throw everything at him like you all try to do by watching my YouTube videos, you inundate yourself. And it causes analysis paralysis. And then you get the guys that are not really trying to learn. They want something to sample real quick and go make courses, mentorships, and write books. So they don't know what to pick correctly. So they just say, screw it, it's too much, it's complication, it's overcomplicated. It's not overcomplicated. As I'm teaching you this week, it's literally the simplest thing you could ever have in terms of trading with real information that helps you see the market before it happens. But all I'm doing is just using one chart, one market, the NASDAQ, keeping your focus on one instrument. You have to start this way. If you haven't noticed, charter members, this is exactly what I told all of you to do in 2016. And every time we had brought in a new group, I would start off the same way. You have to start with one instrument. One instrument. Do not have a list of things, just one. And if it's Forex that you're trading, you have to have a correlated market. Or, I'm sorry, in Forex, you have to have an inverse correlated market like the dollar. So when you're trading futures, it's so much easier because you just simply need one instrument. I don't need SMT to trade profitably. I don't need that. You don't need it. It's just one of those things that help me decide if I want to take the largest leverage on the trade or not. In the beginning, it helped me qualify a trade. Like if I see, because shorting was scary to me. So I wanted to have something behind that idea that, okay, it's overbought, it's showing a bearish divergence in the stochastic. That's what I was doing back then in the 90s. I started with indicators too, but I didn't trust it entirely. And the reason why I didn't trust it because I would lose a lot. So I knew I had to go through that process of getting to the point where I could make money and be successful doing it, even if it's far and few between. I had to keep doing what I was doing to find that initial success. And I wanted a little bit more confidence by having something behind the scenes giving me a little bit more courage because I was lacking a lot of that in the 90s. I know it's hard to believe, but by looking at currency futures, I was using the Deutschmark, comparing their highs against the British pound, against the highs of the Japanese yen, against the highs of any other currency, Canadian dollar, Australian dollar. And I would go through and I would find the one that was failing to make a higher high and the one that was making a higher high. I wouldn't short those because they were telling me they wanted to go higher anyway. So they're probably not going to drop as much. So I used the idea that I got from Larry Williams. And this is, I've already asked, by the way, I just want to interject this. I've asked for years for people to come out here and say that my concepts have been rebranded from somewhere else. And they'll say Larry Williams. I have been open about what I have adopted from Larry Williams. And I've given credit every single time there has been something I've learned from him. I told all of you to buy everything he has. I mean, he's a legend in the industry. Like, he is a real legend. Okay. I'm not a legend. I'm not some superstar. I'm just an average guy. And I've been blessed. But I am going to do the very thing that everybody's been barking about, pointing to this and pointing to that. I'm going to go through every bunch of bullshit that people say I rebranded. I'm going to go into the books. I'm going to go into the page numbers. I'm going to do a documentary on my own stuff and show you that my stuff is not in Wyckoff. It is not in supply and demand. It is not in any of this other stuff. I'm going to take you into the books, okay? We're going to prove this shit once and for all. I have no problem doing it over the holidays January 1st, New Year's Eve, there'll be a documentary where I'm showing you that everything you've heard from all these people is absolute utter bullshit. Okay. But you also get to see me credit the people that were influences to me, but you'll see that there's absolutely no footprint at all in what I'm doing today. I was influenced by certain individuals, but they themselves have no hand in what it is I'm doing. Like, for instance, Linda Rash. I couldn't understand stop rates. Like, I just didn't understand that. And that book, Street Smarts, it was such a simple little approach to teaching it. I was like, oh, wow, I understand that. That's what's been happening to me. Then I was like, okay, well, if she's teaching that you can go against that idea, I never thought about cannibalizing another trader. I was just trying to think, I hope I'm right, like a lottery ticket. Like, I hope I'm right, not thinking about the other person on the other side of my trade. That was the epiphany from that book. That's what I took away from it. Not that I trade 21-day highs or 20-day highs or lows. You don't see me mentioning any of that. I'm looking at how many candlesticks is this candlestick's high from this one. It's not 20. That's not 20 candles. But that's what that book teaches. Find the highest high in the last 20 days or whatever time frame you're using, but they teach day, and or the lowest low in the last 20 days. And if it goes below that, Turtle Soup would buy the break below the old low, or Turtle Soup would sell short above the old high in the last 20 days. The highest high, if it goes above that, that pattern that's taught in that book is a fading of that move, because the turtles, Richard Dennis taught these individuals off the street how to use a breakout system. It was a long-term trend following model, and it had a very, very low success rate. But the times that it was correct, it would capture these huge long-term trends, and it would pay off all the numerous losses that it would accrue. Well, I don't want to trade with something like that. So her idea and Larry Connor's idea was by presenting that pattern, by capitalizing on the low strike rate and success of their model, and they call themselves the Turtles. And I love the name; it's fun. It's like a pun against it. They're souped. They end up in the soup, Turtle Soup. So it's a false breakout pattern that capitalized on the low strike rate of Richard Dennis's approach to teaching people long-term trend following models. And the Turtles were able to make hundreds of millions of dollars. They were managing hundreds of millions of dollars. So you don't need to be successful in terms of a high strike rate, but to me, as a man, I wasn't impressed by that. So it taught me how to look at stop hunts and how I can engage that on smaller time frames and be a short-term surgical striker. Go in, day trade, just like that. And that was the beginning foundation of my intraday model of looking for stops. Now, that is not in Street Smarts, but the idea of getting stopped out and being on the wrong side of the marketplace, that's how I understood it, because I couldn't understand about anything what Larry Williams was teaching. And I'm sure going back through it, I can point to, yeah, there's where he did it, but I didn't understand it then. Remember, I was 20 years old. I was in a rush to get out of a job. I was doing all those same things you're going through. And you hear me say certain things in videos because you're rushing through. You've been working. You're on the weekend trying to cram as many videos as you can because you want to pass a funded account challenge and get paid out. You go back and watch the same video from me and you're like, damn it, he must have made an update or he edited this video because I didn't hear it the first time. And you can watch the same video and hear something new because there's a lot of information being presented. Well, I had lots of books and I would go through them quicker than I should have because it was like a kid in a candy store. And all of this means something, folks. For the people who are like, don't get on with it, I'm getting on with it. The point is, when I'm teaching, you're going to gravitate to certain things and have more emphasis placed on them. And you're not going to have the emphasis placed on the things that you should have. And you won't determine that or figure that out until afterwards. You're going to go back because you have more experience and you go through the information again and say, oh, wow, I can see how that fits now. And that's what mentoring is. You don't learn it one time in a 5-minute video. There's no way for me to condense this. I promise you, you have to go through it modularly, step by step, and expose yourself to it every single trading day. And on the weekends, at least one day of the weekend, spend an hour, 90 minutes to it and just study. And you got to keep a balanced life. But anyway, we're now outside the 15-minute time frame. But when we get into a 15-minute time frame, this is when, if I am going to start looking at SMT, if I'm ever going to consider doing it, if I'm going to look at that, because the 15-minute time frame for Caleb and for the 15-minute time frame for myself, it's a bellwether time frame, meaning that I'm going to lean on a lot of information that this time frame gives me, because I can see 60-minute highs on a 15-minute chart. I can see a 4-hour high or a 4-hour low on a 15-minute time frame. I don't need those 60-minute charts. I don't need those 4-hour charts. I don't need a 2-hour chart. I don't need a 3-hour chart. I don't need a daily chart. I don't need a weekly chart. I can open up, just look at a 15-minute time frame, and I have everything I need to be a day trader. Everything. Because as I'm going to teach you this week, I'm going to teach you a little exercise how you can practice every single day, and I call it volatility pinball, where you're going to be buying and selling up and down all day long. And that's how I just recently did the exercise with my private mentorship, where I'm buying and selling in the same day, in the same session, and I'm trying to communicate how you desensitize yourself. Because many of you were probably like I was. I was scared to get into a trade. I was scared. I was afraid that I was going to have another losing trade. I was afraid that I wasn't going to get the right entry point. I was afraid if I put my stop loss in, it would be hit no matter where it was, because I had losing trades. In my mind, I imagined that if I got short, like say, for instance, say hypothetically, say I got short now, and if I wanted to believe that the stop loss placed above this high would be my initial idea, I would think, no, I got to go higher than that. So where would I go? All right, I'll put it over here. But as soon as I put the trade on, I'm expecting some wild wick to come all the way up here. You ever had that experience? Send me a tweet, and you can put emojis on it if you want. But tell me if that's ever happened to you when you've had a losing trade or a series of losing trades. It's I don't know what happened in my mind as a 20-year-old. I expected some kind of just wild, immediate run up right to my stop. It almost like conditions you to expect no matter where you put your stop loss, it's going to reach for you and get you. That's exactly what I was suffering from when I was trying to teach myself how to sell short. I could buy, and I never had that problem. Like I wasn't afraid that wild, weird wick would drop down real quick and get my stop. I never had that experience. But when I was trying to teach myself how to trust being short or be a short seller, because I've never done it before, every single time I put a short on, I was afraid that it was going to create this really big open, high, lows, closed bar, because that's what I was using back then, not candlesticks. My eyes were better back then too. But I was expecting some wild, weird, freaky candle, or the equivalent today of a candle, to come up and stop me out. And that's an unrealistic fear. It took me years to conquer that fear. I had anxiety every single time I put a short on, because I was expecting some what if scenario. What if it did this? What if it did that? And many times it didn't do it at all. A few times it stopped me out, but it never created that monster candle that came out of nowhere like an ogre, you know? But anyway, let's get on with this. I would use SMT on a 15-minute time frame because it's my bellwether chart. So in other words, because this is my go-to time frame, this is my get up and go, like my gone in 60 seconds type time frame. I can make everything I'd ever need in terms of narrative, bias, draw and liquidity, reversals, continuations, inefficiencies, stops that I'm going to aim for. You know, everything I can pull right from this time frame. You may require a little bit more additional information by having a view of a 4-hour chart or a 3-hour chart, a 2-hour chart, a 1-hour chart. You may need to refer to that. That is absolutely 100% fine. That doesn't mean you're less of a trader than anyone else. It doesn't mean you're doing what you're doing here incorrectly. It just means you're getting more information. There's nothing wrong with more information. You just got to make sure that you're not inundating yourself with too much information that causes you conflicting analysis. So that's why I strip it down to just give myself the daily, and from the daily, I'll drop down to a 15-minute time frame. I'm going to skip over 4-hour through to the 60-minute and go right to the nuts and bolts of 15-minute time frame. So if I'm going to look at SMT, I would do it here. So just notice the lay of the land here. We have a slightly lower high here, higher high here, consecutive little higher highs in here, and then I would refer to ES. You can see the high is higher here now. When the NASDAQ, we didn't have that, so that's SMT. So NASDAQ at that time, since then, it's been weaker. Just remember these reference points here. This high is lower than this one. And now look at this. See this high here? This one's lower on ES than it is for what? NASDAQ. So S&P has an S&T divergence. This high doesn't make the same high that we see in NASDAQ. And watch when I toggle back. See? So that's why you're getting that x-ray view behind the scenes. But you would already know being short in this inefficiency is appropriate because you have this lower high than this one relative to what we just saw on ES. So on my notepad, I just simply note the time that at 8 p.m. Sunday, which is during Asia last night, that there was an S&T divergence, 15-minute time frame, at 8 o'clock between NASDAQ and ES, and NASDAQ is the weaker. So I just put an NQ and a negative next to it. That's what I'm saying. Like my notepad isn't going to help you do anything except for just I'm referencing what I'm teaching you. I'm not drawing it on my charts, but I have the information on my notepad. That's all I'm doing, folks. I'm not hiding it from you. I know if I show this one time, everybody's going to say, hey, could you just show us your notepad today? Can you just show us your notepad? I'm not getting into that, okay? This is something I've been doing for a long, long time. It just helps me reference things. And when I'm out and about, or when I was watching CNBC, I can see that ticker tape at the bottom. And every 10 minutes, the futures market would come by and the Forex market would come by and it would tell me where I'm at. And because I know where we were, the highest high and the lowest low in the last hour, just by using the ticker, you can trade like that, having this information. You're not going to get precision entries. You don't need that if you're trading for the daily range. But when you combine what I'm teaching you and you study how you can watch the tape, really watch the tape. I'm not talking about level 2 data. These jokers that talk that stuff, oh, let me see your level 2 data. That is Mickey Mouse level crap. Like it's literally garbage. You're championing something that is literally being used against you, and you're calling yourself informed money because you're looking at it. Like that's the epitome of asshole. Like you're literally you have no idea what you're talking about. But it seems like you're informed, doesn't it? It looks cool and complicated when you have that volume bars. We've always had the volume at the bottom of the chart. And now volume profile, they want to make you feel like you got something new. They take that and they turn it horizontally to now vertically. Oh, look at that. It's no different than if you just would have laid it down on the bottom. You're looking at something that's already happened. Since you've already seen it happen, okay, wonderful. You've recorded something that already happened. What was the weather yesterday? Right. Does that mean you got to wear galoshes today and rain boots? No. It just means that you knew what the weather was yesterday. Well, when you see the volume, wonderful. You counted how many transactions took place there. Wonderful. I don't care about that. That shit's in my rearview mirror. I'm already looking down the road, 15 to 20 minutes down the road. I'm way down there looking for hazards and opportunities. You're all looking at stuff in the rearview mirror, and you're wondering why you're sitting there all day long waiting for setups. Oh, I'm waiting for something to appear. I'm waiting for this. I'm waiting for that. I'm anticipating. I know where my stuff's going to be at. And you don't need the SMT divergence here to tell you to get into a trade because you can see that inefficiency there is what you'd be entering. You don't need to have any kind of SMT divergence to tell you that trade's good because it's already there. What makes it good? Sell side, buy side, both taken. When we had a divergence back here showing you that the NASDAQ was weak. So we already have a built-in what? We have a built-in heaviness on NASDAQ. It's heavy. And this just so happened to be a little bit more aggressive just to get in here to offer a nice premium. What makes this a premium? Why is this wick right here? Why is it a premium? Because if you look at the range from this candle's high down to this candle's low right there, I'm going to change the color so you can see it. And we draw it out here. Is that wick above the middle center line? See these little outline squares here? That black line right there. That wick right here, that wick right there, that wick right there. Either of them could be short entries because you're in a premium. Because you're inside this inefficiency between this candle 1, candle 2, candle 3. The inefficiency is always candle number 2. Your stop, if it can be afforded to you, is always above candlestick number 2. But if they're small ranges like you're seeing here, you can use the candlestick number 3s. Body, if it has a wick, you can use consequent encroachment of that wick. Don't look at that range from where you'd be entering and think, okay, this is too big of a stop. I don't want to do that. You should always err on the side of what's my smallest risk, because you're learning, Caleb. You're learning. It's not about impressing Dad with how much you're making. You're going to impress me by doing the very least and being consistent with it. Because if you get that under your belt, that is the underlying cookie cutter, that all you have to do is replicate that with more of the same. Multiplying the same effort of something that's done well is easy to do when you learn how to do it well and consistently. But you have to do it with the smallest degree of risk. You have to do it with the smallest degree of leverage. And if you don't, you're going to hear my puppies in the background snoring, and I can't do anything about that, because if I go outside this room, they're going to be barking and hollering, and I don't want that. So just know you're probably going to hear that. It would get on my nerves too if I heard it in the live stream too. So that's a premium, but it's also S&T divergence. Okay, in case you missed it, I'm going to draw it. No, I won't. I won't draw it. I'm just going to keep it the way it was. I did enough talking about it. So we have the opening of Sunday's gap here. That's 6 p.m. and that's the settlement price on Friday. That's what these dashed lines are. That is simply just me annotating the weekly gap. So it's new week opening gap. And now on the 15-minute time frame, I'm going to zoom out. Okay, I'm going to zoom out and take in more information. Hang on one second. If you have headphones on, be careful right now. Sorry about that. I have to just disturb her a little bit because she's starting to really saw some logs over there. All right, so we have, there's those daily relative equal lows. And look what is below it. We have the weekly buy side imbalance, sell side inefficiency. Remember, we were on the weekly chart. I said I think that we could explore going down into the very minimum, the high of that BISI on the weekly chart, which is the high, that blue shaded area. That's anchored on the weekly chart. But it just so happens to be inside of the same proximity of this low and that low. So what's resting right below here? Sell side liquidity. So we can now take, not that, Michael. And as I do this, Caleb, you can only this time you can do screenshots of my charts while I'm doing this live stream, so that way you can have it. It'll save you some time. But this is what you're going to be doing. You do this every single day. You go through your charts and you look at what was given to you with, it's a little too big, isn't it? Okay, so you have sell side liquidity below these relative equal lows. And now with September 23rd's weekly low, you now can state also in there that it is also 15-minute time frame, relative equal lows, sell side. All right, so now screenshotting this, because you can see where the reference point is, and then going back over to where price is now. We have a little inefficiency right now we're trading up into, and we're also inside of another inefficiency that's being shown. I made the mistake because I'm talking. When you draw your inefficiencies, you want to annotate them as well. So you can toggle them and type in whatever time frame it's anchored to. That way, when you're looking at them, they're much more meaningful. I don't need to have them labeled because I'm used to not having them at all, except for just the numerical values. So when I'm watching price, I'm very frequently just watching this over here, this price axis. I'm literally watching that more than I'm watching the candlesticks, because what I'm watching over here, I'm directly correlating to what I have in my notepad, which is every one of these reference points. And I'm constantly writing them in the order of where they're at. In other words, I don't write them in a list that I find this value first, and then below it, I'll find another value here, and then I find another value. I'm not doing that. on my notepad, I'm putting them in the order that they would be on a chart. So in other words, if a price level is 20,013.75, I'm not going to write this this price here at 20,193 if I find that value as a PD array. I'm not going to write that underneath this one because that's not what I'm looking at. I'm looking at how the daily range is going to map out on a piece of paper in a notepad form. And because it's on a notepad, what I do is every single hour, I'm also writing down the high and the low of that hour. And I'm getting a numerical interpretation of what that daily candlestick's doing. And I don't need this chart. I don't need that. You're asking me to show you something that's going to open up a whole panorama, not panorama, but Pandora's box of questions that I don't want to go through because it's just something I've been doing for 30 years and you're probably never going to do it right. And I don't want to teach it because it's not necessary. Use the charts. The charts are going to tell you everything you need. It's just something I started because I had to do things like this because I wasn't able to watch real-time price action. That's all. That's all that it is. And then when I started using this same idea, when I was able to watch real-time price data, I would keep track of it intraday, and I would add more information. I didn't have all these reference points because I didn't see them when driving around in a step van when I was servicing soda machines and candy machines and cold food and coffee machines. That was my job. But I was so used to doing it, it was just a habit. And that's what I have. I have a notepad with these reference points. It's not something that's scientific that's going to make your trading better. It just means that's what I do. You don't need to do that. You just use the charts because the chart's going to tell you everything you need. And you want to use a time-based charts. You don't want to be using Renko bars. You don't want to be doing any kind of range bars. All that stuff is going to hide the very things I'm teaching you that is time-based. The algorithm operates on time first. If you're using Renko bars, or if you're using there's all kinds of stuff out there that anything like a range bar, Renko bars, or the equivalent. If they're not showing you the open, high, low, and close on an interval of time, you're not going to be able to see what the algorithm's doing. I promise you that. Everybody out there that wants to talk algorithmic shit, they just place that little name, that buzzword on there because it's going to make people think they're informed. I'm teaching you how to look at the very aspects of time because the time-based chart and a candlestick is easy to see versus an open, high, low, and close bar. This small little inefficiency in here I know, Daniel, I'm not drinking from your Yeti. I was in a rush to get in front of the charts this morning. I have used it several times there, by the way. Who's Daniel? All right, so we have a SIBI here, sell side imbalance, buy side inefficiency. And we have the 60-minute discount wick consequent encroachment. That means on an hourly chart, that big long wick that went lower, that made a swing low at, that's half of that wick. So in my mind, before we drop down to a lower 5-minute chart now, in my mind, I'm anticipating a run to this level. It might want to go down below it, come back up, dilly-dally around that consequent encroachment level, worst case scenario, and then dive into the sell side, resting around that 19,953 level, okay? So I anticipate that happening. I am not imposing my will on the market. I'm not saying it has to happen because I want this to happen. I wrote these things on my chart, so therefore it has to happen. No, the market has to indicate that it wants to do that. It needs to do certain things, and we're going to look at that today, okay? But up till now, this is my pre-market analysis approach. This is all it is. Is it complicated? No. I did more talking about other things, probably pissed a lot of you off, but it's a matter of simply doing what I just did here. Looking for reference points from the higher time frame weekly chart, because you're going to have to refer to where are we at, where could it be reaching for the weekly chart? Because if you don't refer to that, You're going to hide all of these really big runs that might jump out at you unaware. You'll be unaware, and you won't be expecting big moves if you don't have the big move perspective time frame in mind, which is the weekly chart. A sustained price run is going to unfold if the weekly chart, if the monthly chart is indicating that it's likely to go to any given higher or lower price. But if you're framing your trade on the basis of just a 15-minute time frame, and that's all you do, if that's all you do, you won't have the perspective that's required to capture these big monster several hundred handle runs, even if you are not a swing trader or a short-term trader. But wouldn't it make sense if you could just go into the chart one time at the beginning of the week, say, okay, here's the lay of the land, this is what could happen, and at least have it on your chart. That way, because they're in your charts now, they're annotated in there, you won't forget about them, because as price, let me ask you this, if price started to break down in here and it got down to this level here, knowing what I've already shown you, would it be easy now, because I walked you through it, would it be easy for you to trust that it's going to at least trade down to the consequent correction of that wick? If it was trading like right here, wouldn't it be reasonable? Wouldn't it be easier for you to trust that versus right now? Do you feel confident that it's going to drop right from here? Some of you may not think it's going to do that. Some of you might think it's going to go higher before it does that, ICT. Or you're wrong, ICT, I'm going long. Whatever. The point is, my question was, if it dropped sharply and was trading right about here, would it be easy at that time for you to submit to the idea that it's probably going to trade down to that mid-wick level on the hourly chart? And if it went through that, wouldn't it be reasonable to see it trade down into these relative equal lows, because they're really smooth, right? Can you see how price could work from this level here, not at that level specifically, but in this general region, because we have an inefficiency that's shaded there? Can you see how it can move from this one to the blue one? Can you visually see how that could be delivered? Because if you can't see that, that's going to be problematic for your trading, because you have to be able to see your setups. Before they're there, you have to be able to see how that could pan out. And that's an experience-driven thing. It's not something that you're going to be able to see the first time, Caleb. It's over time back testing. That's the point of taking screenshots of trades that you did not do, but you mark them up and you talk in the chart annotations like you've seen it coming, and you congratulate yourself, and you're tricking your subconscious mind. And I'm literally going to be doing 2 days, not every day, but I'm going to do 2 days, Caleb, where I'm actually going to annotate in a journal perspective. That way you see exactly what I'm talking about when I'm saying that you need to sweet, soft talk yourself into seeing it. But it's going to be in hindsight. You're going to see it in hindsight because you don't have the skill set yet. But by recording it and annotating your chart with the things I teach my students, it tricks your subconscious mind. So that way when they look at your, well, they're not going to look at your journal, but when they look at their journal and when you look at your journal on the weekend and you read your own comments saying that, yes, it was amazing to see how I expected this to pan out just like this. It's textbook. You keep giving yourself a cheerleading milestone. Every time a new chart's presented in your journal, you're annotating everything that happened in hindsight like you knew it was going to happen. And by doing that over a repetitive period of time, I don't know how long it's going to be for all of you, but over time, doing that as a ritual every single day, it's a routine, it's a regimen that you do every single day, and you journal every single day. You will get better at reading price. You'll see the setups before they form. You'll anticipate them. And then when they do form, you'll be able to learn how to trade them. Okay. And last week I was supposed to do some work on limit orders. We'll absolutely be doing some of that today and throughout the week. But the ability to see the potential, how it could deliver from this inefficiency down to that one, it makes sense that it could do that. And it need not be an overall reversal long term and still see this deliver like that. It could go down here and upset this here and then create some important low and make a higher high and go to all-time highs. Don't think that we're trying to predict, or that I'm trying to sell the idea that I'm predicting the top in the market. I'm not trying to do that. All I'm doing is I'm framing, this is a best case scenario. This is how I frame it in my mind, okay? When I go through my first analysis for the week and my pre-market analysis, I'm looking for things that I can hang my hat on and say, okay, push comes to shove, I am going to submit myself to this above anything else. But if I don't have something that allows me to get in a trade like this, then I'm going to trade with less leverage when I'm taking longs. Do you see what I just did there? I gave myself permission to be wrong about this analysis, but this is the one that I'm going to do the heavy-handed leverage on. So I want to be a short seller with my heaviest leverage aiming for that sell side right there. That's what I'm doing this week. It may not go there today, but that's what I'm looking for this week. That's my real good one shot, one kill setup. Hello. I'm teaching everything that you've asked for. But can you imagine how I have to go through a lot of things to show you why it's important and what other things are not required? Because you've been watching lots of my videos and you think everything I've ever talked about is necessary for every trade that sets up in your time frame. It's not true. Not every single price run is going to have a propulsion block. Not every single price run is going to have an institutional institutional order flow entry drill. Not every single one of them is going to have a breaker. Not every single one of them is going to have every PD array. But there will be a fair value gap in every fucking one of them. Okay? That's the one that's always going to be there. You may get a little late in the run, but that's okay. As long as that fair value gap is in a premium relative to the range that's going to span from to the target. Target is this. Okay? This is terminus. This is if we trade the here, my best case scenario, my weekly one shot, one kill has been satisfied. If I do any other trading, it's just going to be scalps. Now, I have answered a huge list of questions just with what I've done so far here as a monologue. Now, let's go down into a lower time frame. 5-minute chart. All right, so we're looking at a 5-minute chart with the new week opening gap. That's what that purple dashed lines are. The only concern I have is that these highs, even though there was SMT between ES and the NASDAQ, recall that this high here on ES was slightly higher than that of the respective high here. I'm going to toggle back to ES and show you in a second. Just give me a moment. But looking at this chart, if I'm wrong, I do believe that we're going to get down here, like based on what we have right now. What changes that? What makes me put that idea on the sidelines for a little while until something gets back in favor of it? Because I'm not infallible. I have to have a contingency plan. If this is what I'm looking for, if I want to see price trade down there, and I'm only interested in taking that type of trade, then what am I doing? I'm imposing my will, and I'm teaching you not to do that. Okay, give me 1 second, folks. Scalp. Scout's over there snoring obnoxiously, man. It's like a lumberjack. Good grief. So I'm teaching you not to impose your will, Caleb. Just because Dad teaches you to do this with your analysis, it doesn't mean go in there thinking that it's going to be just like you think. Because the market will humble you quickly if you come in there with your will being imposed. It's going to take your will, chew it up, spit it out some days, and that's the reality of it. So you save yourself a lot of emotional damage, psychological impact that's adverse if you just open up the idea that you could potentially be wrong. But if given the opportunity to find a short trade, this is what I'm aiming for. I'm aiming for that down there. And everything I've taught on this YouTube channel, you all should be able to see how that fits perfectly. It's not something, it's not like a new science being taught here. You can clearly see, oh, this makes perfect sense. Even if the overall higher time frame bullishness is still going to be in play and it makes higher highs on the week after it goes down here, I don't care about that right now. I don't care about that. I just know that I am presently, at this moment, I am not interested in being a buyer. I don't want to be a long holder. I want to see it trade down here, because think about what it does by doing that. Anyone that's long, if it trades down, this is the part for narrative purposes, because I've already given you a bias, but now I got to tell you how it might deliver. So this is where I think it could go. Could and will it is two different things. But if I can frame a narrative, a game plan, a way that the price action will be implemented in people's charts to entice them, to lure them, to unseat some, to allow their seat to be taken by someone else with deeper pockets. That's what narrative is. It's how the market will manipulate the participants and traders through sentiment or sudden movement in price action, because they're going to rush, they're afraid to miss a move, so they're going to chase price. All these types of things, I start going through my mind, think, how could that be implemented? Because just having this analysis is not enough. It gives you a foundation to operate in, but what can I do in my mind to flesh out a narrative? Why would it be going down in this blue area? You have to have the best case scenario on both sides for a narrative. What I mean by that, I've already submitted to you that I am not trying to be someone that's trying to pick the top in the NASDAQ. I'm not trying to do that. And I'm not suggesting at any capacity at all that by me expecting any kind of short in this area here to trade down here, that's not me predicting the top. And that wouldn't be unsettling for the underlying bullishness of the NASDAQ on a higher time frame. In fact, it's actually very constructive, because we've traded higher for a good period of time, over a month or so. And coming down here to absorb trailed stop losses in the form of sell stops or sell side liquidity below relative equal lows, it's advantageous for people to take shorts off at that level. That's a good area for smart money to recoup their short position and cover. And if the market is in fact going to go higher, this would be a great place to take price down there so they can accumulate longs there. So what did I just do? I framed both sides of the narrative, how retail can be cannibalized. So narrative is, how can price be used to facilitate the means of smart money getting in, holding to a particular price level, and then once it gets there, what would they do next, and how would that be advantageous for them? I may be entirely incorrect, and it may never even go down here this week, but I have to go in with something at the beginning of the week as a framework. I've already said that it doesn't need to do this for me to define trade setups. It just means that this is where my heaviest handed leverage will be anchored to a trade that trades down in here, because I want to be a short seller in this area. Because my belief is, if smart money has sold short last week inside that daily fair value gap, then why would they want to just be taking profits here when they can take it all the way down here and get a huge range and onboard new longs if they're bullish? Because that just cancels out the need for me to be worried about picking a top, right? I'm not trying to pick a top. So having the discussion of narrative in books, I can only do one case study or two and have pages of it, and it won't scratch the surface. That's why I talk about the things I talk about over price action, because I need you to understand how you should internalize price. Because there is an entity that's smart money. They are greedy. They're more greedy than you are. And they have the advantage. They have the inside track. They know exactly what this algorithm is doing. They're doing more than I'm doing. They know more than I do. And they're in partnership. So they're like a confederate, okay? If you were watching a magician at a show, they employ what is called a confederate, someone that's in the crowd that you don't recognize as part of the show, but they'll say, all right, let's pick somebody from the crowd. Well, as soon as they do that, chances are that that's a confederate. That's somebody that's already part of the show. But they'll blur it up a little bit to make it look like it was a random selection of that person. So they're all part of the show. Well, smart money is part of this rigged game system. They're part of it. And the algorithm is just the price engine that delivers price up and down and goes to these points of reference for the purpose of trading to engage the liquidity or reprice to inefficiencies. That's the only things that happen algorithmically. If it's not being delivered that way, then manual intervention comes in, and then you see what we saw like last week. Or FMC, or like when Powell starts talking today, that's absolutely 100% manual intervention. That's why you should not be doing anything while he's talking. And for 15 minutes after he stops talking, start looking in price and looking at my PD arrays. And when they start booking perfectly to the tick, that means everything went back to algorithmic delivery. But if I'm wrong, let's say I'm wrong, okay? Because that's always a likelihood. There's been times where I've had in my private mentorship where I gave my weekly analysis. I wasn't 100%, but I was in the high 90s, accurate. But the times that I'm not right, I have to have a contingency plan. What would I do if I'm not going to sit still? Because I can't tell you I'm going to sit still on a Monday. And while we're at it, today's Monday of non-farm payroll. I am always trading that Monday. I'm always trading on the Monday of non-farm payroll. I tell everyone that's a new student to just sit still on Mondays outside of non-farm payroll, because they usually use that day to set the initial parameters for the weekly range. And you might get chopped up. You might have a winning trade, but you hold on to it too long and it turns against you. Or you're doing it wrong because you just don't know what you're doing. So that's why I tell new students, don't trade on Mondays and start their trading on Tuesday. Their active participation, and say it that way. So because it's Monday of non-farm payroll, and we have Fed chair talking this afternoon, we want to be able to find our setup within the first hour of trading. So that means 9:30 to 10:30. In that 1 hour interval, if you can't find your setup then, don't do anything. Just simply sit still and don't do anything, okay? Because the closer we get to Fed chair talking later on in the afternoon, the closer we get to the afternoon lunch hour, which is technically 2 hours, it's 11:30 to 1:30 p.m., the more likely that you're going to get slapped around and you'll get beat up. So you have to have a limit in terms of the time that you're willing to do something on the day that the Fed chairman is going to be talking. When they're talking and just before they're talking, the hand comes in, the manual intervention, the thing that you don't expect to see in price. And if you're in there, you're probably going to get crushed. You're probably going to get stopped out. You're probably going to get scared out of your trade. Everything that would go wrong, that could go wrong, is going to happen. So don't be in the marketplace then. I don't know why anybody would argue against that idea of preserving capital, because that's all it is. You are in the times when the market is the least likely to pan out in your favor. And if you win, it's just happenstance. It's this, that it just happened that you were on that side that time. It's not a consistent thing where anybody can go in there and say, okay, the Fed chair is talking, so I'm going to go short while he's doing this, or I'm going to go long like that. Anytime someone makes money like that and they want to show it online, just block them, just mute them, do something, because they're literally just trying to get an attaboy or an attagirl. And I'm telling you that that's the worst time to be in the marketplace. It's the worst, because you don't know what they're doing. This is the person that's the head of the Fed, okay, the Federal Reserve. These people are not looking out for your best interest. They're not. They're controlling a narrative. They're trolling us right now over the last several years, okay? And everything that's being done to us as an American society and through the economic cycle is punishment. So they're not going to be honest with you. They're not going to tell you how to help you make money, okay? They're going to tell you something that is absolutely useless to you in talking points. So you might as well just let them do whatever damage they're going to do, wait 15 minutes after they're done talking, and then go in and see what we have. If the prices are reacting to my PD arrays and inefficiencies are trading into them and then leaving them right away, you can tell that we're back to algorithmic delivery. If it's not like that yet, don't trade. Now, doesn't that make that very straightforward and simple? You have rules. When you should, when you can't. Not when you might, it's when you should. And if it's not when you should, it's every time, no, I'm not doing anything. You have to be much more rigid about when you don't do something. And don't create these little pockets of, well, I would normally not trade here, but I just feel like, I'm going to probably get this one right. That's impulsive trading. Impulsive trading, Caleb, is how you are going to lose money, because you have that little tendency, like I have, where if I'm provoked, I'm going to bite. If someone chests up to me, I'm there to knock their fucking block off. I'm like that. I'm confrontational. But in trading, you'll have your ass handed to you. And you have to be very, very careful that you don't invite those instances. And if you feel like that you're going to have that influence, even on a day where you see everything is good, technically, there's no manual intervention likely to happen, it's low resistance liquidity runs. If you feel that impulse, if you feel that tendency coming over you, turn the charts off. I'm your dad. I know what I mean by that, and you know what I mean by that. But anyone else listening, if you have a reckless disposition, that's my permission to you also. Even though that we may be in low resistance liquidity run conditions, you have to identify where you're going to be euphoric or manic or out of control, impulsive, greedy, or at the highest degree of panic, and you get paralyzed. So that these are all things that you discover about yourself in the first stages of documenting your development and journaling. What do you feel when you're watching price action? Do you feel euphoric? Do you feel scared? Even though you're not even in a trade, do you feel antsy? Do you feel like you're looking for everything to cause that trade not to be profitable, so that way you can say, I saved myself a lot of time worrying about this because it didn't work. I watched it happen, fail. Like, these are all critical things you have to take inventory on. But when you're trading in days like this, where we have a looming event in the afternoon, you will see manual intervention today. Guaranteed it's going to happen. You're going to see it. You can predict it. You can anticipate it. We are not going to wait to see if it happens and then react to it. We know that there's a pothole down the road in the afternoon session. So don't trade the afternoon session. How hard is that? Some of you say, oh, he said not to do it. I'm going to go out there and do it. Well, I understand that. I read a sign that says don't walk on the grass. I want to moonwalk on it. I know it's natural tendency. That's our sinful nature. But in trading, why are you going to invite recklessness that causes you to lose money if you're wrong? I'm not going to be impressed if you come and show, hey, look at this. ICT said this. I'm never like, oh, man, I'm exposed. He took a trade in a time I said I wouldn't take a trade. He should do mentorships. Let me sign up to his mentorship. I'm not thinking like that. I'm thinking you're a goober and you're literally gambling. That's how I see it. I see that with anybody that's trading. If you're live streaming, you're trying to do it during these time series, you're an idiot. Like, you're an idiot. You're literally asking to have your lunch eaten, and you're leaving a tip. So we're in a 5-minute chart. We have our inefficiency here. We're going to drop down into a 1-minute chart. I may not go down to a 15-second chart this morning. We will be in a 15-second chart every single day the rest of the week, because I want to go in and teach you volatility pinball, where you're literally engaging several times in an hour. You're buying and selling, buying and selling, buying and selling. And what it was for me to teach myself to get over the fear of shorting, I had to desensitize myself. And that idea came from Larry Williams. Out of his own mouth, he said that he was scared to take trades. And because I heard my hero say those words, what did I do? I associated myself with that. Oh, so he feels that way. I'm 20 years old. I'm impressionable like all of you are. He said something, and I was like, you know what? I want to associate myself with this man as much as I can. I want to emulate this man as much as I can. I want to be successful like this man as much as I can. So he says that he's afraid of taking trades. Before I started trading, I had that underlying thought process. I wonder if I'm going to be scared of trading, but I wasn't initially. I just went in there and like a cowboy, just jumped on that bull and rode, and I was only buying. Look right here. going on here, man? There's sell side resting right below there. So I started with this. I'm going to go in and I'm going to just go short and try to defeat these demons that I'm afraid of. And I was afraid every single time, like full-blown anxiety attacks every single time, and it's horrifying because I didn't understand what I was doing. I knew I could lose money because I was losing money as a long holder. When I would go long, I would have losing trades. I could make money, but I would lose it too. And because the market had shifted, everything that would have been bullish was just a small little consolidation, and then it would drop lower. So I would be tricked into thinking that the indicators that were oversold and diverging bullishly and whatnot, and my moving average, and maybe even sloping up on a 50-day simple moving average. I'm sorry, exponential moving average. That was my model back then. And because everything at the time was going up, I was in a 90s bull market. So of course, it's not skill, but I felt like it was. And I was on America Online trying to teach people how to do what was obvious. The market was going to go up, right? So I tricked myself into thinking that I was hot shit back then, and I didn't really know what I was doing. And then when the market went to a bearish phase where it just wanted to go lower, every time I bought, I lost every single time. And I would just erode the account, and I'd have to work a part-time job in addition to the long hours I did. And it was terrible. It was terrible to get the little bit of money scraped up again to put into an account. And I would repeat the same cycle over and over and over again. And then I was like, well, I got to learn how to be a short seller. Like I have to be able to do this. And the way I overcame that was use the logic that Larry Williams said he did. He was afraid of taking trades from the beginning. And in the beginning, I wasn't. It was something that I adopted because I want to associate myself with him psychologically, and I was emotionally committed to being a student of his. He didn't know me from anyone, but I wanted to assimilate with his thought process on everything. And the only thing that you should assimilate with me is how Price books. Me as the person, none of you should look up to as a hero. I am not someone to look up to. I am absolutely 100% fallible. I am a sinner. I am not a good role model. I say things to incite people emotionally to cause them to come here for the express purposes of proving them wrong. I get off on that. That's not something that's a good characteristic in a person, because I feel like I have to scratch an itch that's deep rooted in my childhood. I have that all the time in me. That's a character flaw. That's why I'm not the best mentor. I have a deep rooted vendetta that I have to prove myself to my grandfather, not you listening. I have to prove something to my grandfather. I can't do that. So I'm never satisfied. So it causes me to do things impulsively. And that's why you see me do the best I can in terms of managing that by inflaming other people, make them come here and prove that what I'm doing isn't true, isn't real. And then when I make profitable students and they become millionaires, it's satisfying to me. I twist the knife because it satisfies me. If I was in 100% control over myself, I wouldn't have those impulses, but I don't. So therefore, I'm not the best mentor because I'm riddled with that. So, but in terms of price action, you absolutely should assimilate yourself to that, because what I'm teaching is distinct from me as the man, the person. I'm not here for friends. You should never want to meet me. You're not going to be impressed. I'm not going to want to be friendly with you. I'm introverted. I don't sound like I'm introverted because I'm talking to a screen with my child in mind. But if you met me, I would not feel inclined to be able to talk to you like this. It would take time for that to happen. I met one of my students on the internet, one of them, just one, and I was extremely uncomfortable, very, very uncomfortable. And I don't want to do that again. As much as many of you want that to happen, I don't want to have that happen. What I'm watching here is see how the bodies are just hanging around the middle of this inefficiency. 9:30. Let's take a look at the. So we have a discount gap That could trade up into here. I know, it's an ugly color. All right, so we're in the lower quadrant of that opening range gap. I was saying earlier, and I didn't get a chance to say because I was discussing other things. If I was wrong about it going down into the weekly imbalance and that hourly discount wick, it may want to come up and take buy side out. So it could take a pass through. This is assuming I'm wrong. It could trade above that and really entice people to think it's going to go higher. And then I'd have to wait for it to break down again and then get down below whatever first fair value gap that forms in the 1 minute chart, which is yet to form. But any setup, the entry would have to be in the first hour trading, so between 9:30 and 10:30. And if there's no entry, there's no trade. I would simply tell Caleb he can't trade. He can't take a trade today. But he can trade all the way up to inside that first hour. So that means what? He can take a silver bullet. I don't know what that is. What is that? Huh. I must have laid a rectangle down and didn't complete it. There's nothing in here. I'm looking at there. The buy side has been ran here. So we went above the opening range gap relative to last Friday's settlement to today's open. That's what that yellow box is. Any of this run here, I'm not interested in any of that. If it keeps on going higher, it simply means it's going to do it without me. See how liberating that is? I'm not arm wrestling and saying I have to be in here long. I have to figure out a long. If I'm wrong, I have to figure it out. No, I don't. You don't have to either, Caleb. Social media has a terrible tendency to make people think that someone else out there is always taking the trade that's moving right now. And I'm telling you, I have lots of ways to get into every single type of move. I'm not thinking that way, and I'm certainly not trying to do that. And nobody out there as a trader should be trying to do that. Top of that inefficiency that's shaded here, this one, that low shaded area to that high shaded area. It could come up here and hit that. If it's going to go there, it would make sense for it to wick above, take the liquidity out here. Otherwise, it would need to stop with the bodies in the upper quadrant of it, right about where it's at, and roll over. Anything that's shown here right now, I'm not interested in any of that. Just want to take a quick look at ES and comparison. All right, you can see what ES can do, right? Right here. There's your buy side. So it might be trying to get up here to disrupt this. So for ES, we can monitor this one, because it does definitely have a draw on liquidity there. Look at Dow. Look at Dow. So what we're seeing here is the decoupling. Decoupling is when all three averages are doing something different. This drop down is not seen in NASDAQ. It's not seen in ES. Let's go back to ES. See that? So I would expect them to come up here and disrupt this. They don't have to, but it would be much more meaningful if they hit it and then started to sell off. That means they took out these individuals here. If they take them out, what are they doing it for? They're taking them out to take their stops, and they're going to sell short against those buy stops. So anyone that's short, they have their protected buy stop right above here. So it's reasonable to anticipate the market want to go up there. What would be the narrative for that? Well, if it goes higher on a day, it goes without saying that that would be a nice area for them to take partial profits and lock in something profitably. But I like the idea of it going there to see if it can unseat these individuals. They don't get to have the profit here. It's being taken from them. And then if it sells off from there and it starts to build in technicals that would send us down to that sell side, that's the idea, and that's the side of the market I want to be on. This is all just me watching and monitoring and just, yeah, okay, we're tape reading it. I'm not in it. I don't want to trade it long in there. We can, but I'm not interested in it. I want to see what we do when we get there. Add to it that we have the indices not agreeing. So the only element of Dow theory that I do use, okay, is I like the idea if I'm bearish, I want to see all three averages moving in the same direction. That's simple, okay? But I don't see that here today, neither do you. The Dow has dropped. The NASDAQ has gone higher. Well, let's go back to it real quick. The S&P is obviously doing what you see it doing here. So this is a decoupled. Actually, let's just watch them hit the stops first. Then we'll go to NASDAQ. Whenever you're trading, looking for a setup, or when you're in a trade setup, you want to see all three averages agree. That means if you're bearish and you're in a short, even though I don't like the Dow, because there's only 30 stocks and it's a little unruly, that's why it's called the dirty 30. The impact on its movement by and of itself is not all that important, but it is usually sometimes the canary in the coal mine, where if we see the Dow just saying, nah, I'm not doing something that you other two are doing, that may be indicative of something changing. Not all the time, but if I do see a divergence between the NASDAQ and the S&P, and they're not doing the same thing, that's clearly a time when you don't want to be trading, because you're in a decoupled condition, and you're most likely playing in a sandbox where manual intervention is about to happen. You're gonna have sand kicked in your face. You're not gonna be able to see what you're doing. You're gonna lose visibility, and you're gonna lose money. And if you lose control of yourself, you'll wreck yourself, go on tilt, and blow your account. So long story short, you want to have a day or a session when you're trading where all three averages are agreeing. So we'll cycle through. We just went right back to the same high. I think they're going to still go up and hit that, but let's look at NASDAQ. Okay, so we took out the highs. We ran over here and took the high out over here. I told you if it was going to go to the high, that shaded area, it'd be reasonable to anticipate them blowing out the stops above here, which we've just seen them do that. There. See that? So I would want to see it. Unfortunately, it's probably going to have to hang around up here until ES completes its rotation for buy side here. I mean, it would be highly unlikely for it to leave it like that and just start to drop. It's happened before. We saw that a couple weeks ago with the NASDAQ. It just left those quadruple highs up there and dropped like almost 1,000 handles, and then came back for it later on. And now watch with the Dow. Are they all agreeing? No. So how can you feel comfortable sitting on the sidelines and that you don't have a trade on right now when the market looks like this? All three, in a perfect world, when there is symmetry, this is not a symmetrical market. A symmetrical market is where all three averages are moving in the same direction. This is saying, I'm not even going up there. I'm going to go lower. which to me, I'm taking that based on what I've already did as in the pre-market analysis, that this is the canary in the coal mine. It's saying that there's something wrong with this. Let's go back and look at the other indices. Here's the S&P, and here is the NASDAQ. So I would like to see NASDAQ just stay here, hold it like a bull flag formation, let everybody anticipate it breaking higher, and then a sharp breakdown lower, and then inside the opening range gap, treat the midpoint. Once it gets below that, treat that midpoint as a premium, and then sell off from there and displace. But we have the very first fair value gap here on the 1 minute chart is at 931. It's rather large there. And this is all ahead of the Chicago PMI too, by the way. That comes out in less than 4 minutes. So I take this as them fluffing up the market, stopping out any individuals that were short, and then they may elect to take the market down sharply into our objectives here on the day or going into tomorrow. That's kind of like what I internalize. Scout's such a little tiny boxer. Like, she's little, but she snores like a Saint Bernard. Sweetie, but she's, I don't know, she's got an awful snore. We don't care about your dog, ICT. Put a trade on. Sorry, this is union rules. All free have to talk about things outside the chart to distract you. Union rules, man. We have to do it all the time. This guy's an asshole. I see it. Look at the Dow. This is garbage. You guys want to trade this one, man? Like this to me. I know some of you are like, oh, this is my thing. This is my thing. You can have your thing. Look at that. It stopped dead on the high. That would annoy me, to be honest with you. If they just dropped it from there, that would absolutely annoy me. But it would mean that we're probably going to have to come up there later on, which would be fine, right? If they're going to take it all the way down to our NASDAQ objective, they're leaving what up here then? Buy side. So coming all the way down to that deep discount on NASDAQ and dropping ES and sympathy with it, this would be where the market would draw to on the upside if it goes down there. Down where? Down there. So looks like we're trying to build in that pseudo bull flag thing. So right away you can see how and why I don't keep all this stuff on my chart, because to me it's absolutely distracting. But I have to have these things framed out for you to understand what I'm looking at. So if I'm holding an opinion around certain key levels, what are they based on? Well, everything I've outlined here. All right, 30 seconds to Chicago PMI number. Ten seconds. We'll see some volatility. This is a medium impact news driver, so it's not red, but it's inside that first 30 minutes opening range, so that can tend to be a little bit more animated than normal. We really should be looking at ES, Michael. See if they run those relative equal highs. No matter what price is doing in this environment, because there's a decoupling between all three averages, that gives me a confidence to sit still. If every average was moving in the same direction, I would feel like they were probably going to take it higher and continuously move higher. But because the Dow had already, like, imagine a canary, a little bird. Okay, coal miners used to have these little bird cages in the coal mine with them, and because they're a smaller little animal, their lung capacity is smaller and they're more susceptible to adverse climate and environmental changes. When oxygen levels would drop to dangerous levels, the coal miners would know that because the canary would stop chirping and it would be dead. So the Dow was, in my opinion, so far, that's what it looks like. It looks like it was the canary in the coal mine this morning saying that it went down when the other two averages, the NASDAQ and the ES, went up. ES has unfinished business here in the form of buy side. So that's the holdup for anything going short for me. I want to see it go here, disrupt these relative equal highs, and then see how we trade after it does that. And I would like to see it move lower sharply after it goes there. So I'm sitting here, I'm waiting for certain criteria to be met to frame the idea around the narrative I already outlined this morning. We have a few clues that might be in play, but we still have to work through the effects of the Chicago PMI. Not that the data itself is moving price. They use these high impact or medium impact news drivers. They use these as smoke screens, basically, is what I'm getting at. Like it's easy to justify on the news, oh yeah, the market had a so-and-so rally to blah, 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 because of the Chicago PMI number. The market's not reacting off of the number. The market's going to go to where it needs to go. In this case, it's going to go to where the stops are. But anyone that doesn't think the way I'm teaching to look at the market algorithmically for the purposes of taking liquidity, unseating individuals, and taking over their position, or knocking them out of their profitable position to add more to their longer term profitable trade, that's what the market does. And by having that perspective, it in my mind it does give me an advantage versus just looking for a pattern for sake of it appearing in books and people say it works. I've lost money on patterns. But knowing where the liquidity is, the time of day, how this entity cannibalizes other traders that don't realize that it exists. It's like that monster under your bed. It's there. You know it's there, but you're just too afraid to bend down and look underneath it or let your foot dangle off the edge of the bed. So in 2024, you have been getting a clinic on how to avoid adverse market conditions. Markets are moving around, I'm not denying that. But they're moving around in a manner where I can be comfortable not being a part of them because it fits the logic that I'm teaching. What happens when these things are not in place in price? We're active. We're in there trading. We're in there taking setups, and we have low stress. We have no anxiety. We have 100% trust in what we're looking at because we don't have these things plaguing it. A perfect world, a perfect trade setup, all three averages are going to move together. That's Dow theory. That's the only extent of Dow theory that I have. That's it. I want to see the averages confirm. And I didn't learn that part from Dow theory. I learned that from George Angel. So that idea of when S&P is moving higher or lower, because when I first started trading S&P, I would have the NASDAQ, I would have the Dow, I would have a tick chart, I would have a couple other little retail things that are not even important. And I would use the idea of all three of the averages needing to move in the same direction if I'm bullish or bearish. And at that time, I was using floor pivot numbers. And that was my support and resistance, those levels, those numbers. And I didn't understand when I was watching them trade through those levels that there was something else going on. It was going to the liquidity that's beyond that floor number. Just because those numbers are calculated on the previous day's open, high, low, and close, it doesn't mean that it's going to be the low of the day or the high of the day or the session. But liquidity below an old low or old lows can be the low of the day. Liquidity above an old high or relative equal highs can be the high of the day. And the pivot number is just a suggestion of where it might reach for. It's like a draw on liquidity, but it's never ever to be viewed as a terminus level where this is it. It's never going to go beyond that. That's the mistake I found I was making, and I think every other trader that uses floor numbers and pivot numbers, they use them as a panacea. Like nothing's a panacea. Like literally nothing in trading is a panacea. There's no be all end all ends everything. It answers all questions. Because if anything like that existed, number one, I can tell you honestly, I would never teach that, and nobody else would either. So stop looking for it, because no one's going to share that with you, and they're never going to sell it either, even if it is an expensive amount of money, because they could sell things for $5,000 even though it's for free on YouTube. If they believed it was exactly what they try to market it as, they would never sell it. They would just simply use it, because that edge would diminish. Well, the reason why I can teach this is because this is the market. It's the lifeblood of markets: time and price and liquidity. If it ain't liquidity, it's inefficiencies. And that's always going to be the game. It's never going to be anything but that. All right, looks like we could make an attempt to get up here. Finally work those levels out. Got 37.5 minutes where Caleb could still find a setup. Take a quick look at that real quick. Yeah, still ugly. Okay, see what it's doing? It's just hanging around. I like that. I like this. To me, I view this as it's got to look like it's trying to be bullish to allow ES to do its damage on those relative equal highs. That's how I see this. This right here, it's ugly. It's really, really ugly. That's exactly what I was telling you. It said it's going to hang around in like this bull flag type formation where people are going to want to see it go higher. They want this to break out to the upside. Retail traders want to buy this. They want to be long in this, especially after seeing all this shit. So by having ES with its unfinished business up here, here's what's happening. Phil's watching my live stream this morning. And he's like, I'm going to fuck with you today, ICT. We're going to sit here and just hammer that. It's okay. It's okay. I'm still going to make money today. I'm still going to make money today. It don't have to be in this stream, bro. But we're waiting for the green light after the buy side's taken here. Mm-hmm. Now, let me ask you a question. If you were, say you went long, okay, say you were long in here, somewhere in this area, or maybe you use this inefficiency here, how would you feel with the way the market is trading right here? Would you feel uncomfortable? Would you feel like you're comfortably going to submit to it eventually break into the upside to get these relative equal highs? And would you expect that to continue if it goes up here and keep moving higher? Or are you trying to just get out and be done with it here? Because admittedly, I would be a little uncomfortable with the amount of time it's spending in here. Because it could very well do what we saw a couple weeks ago, the same thing with NASDAQ. And it would fit the underlying idea about if it's going to drop for NASDAQ to go down to that weekly inefficiency, by them leaving this area up here smooth like that, because it doesn't have to go up there and do that. I just want it to do that, and then that would give me confidence if it starts to break down, then we can take our attention over here for sell side for ES, and then more specifically what we were looking for NASDAQ, down here, right there. So while it's up here, retail traders are not thinking anything down here. It's completely outside their radar. They're not linked. They're not even thinking about it. They don't think it's even possible. They're looking for a continuation to the upside. A small little gap here. Yes. Now, you've learned again something new today. I've taught this already. It's on Core Mentorship on my YouTube channel. If you look at 2016, 2017, private mentorship, that's my paid mentorship lectures. And there are people literally on Instagram, on YouTube, on Twitter, everywhere trying to sell those same videos for free. They're on my YouTube channel, but they're trying to sell them to you. Don't be a stupid ass. Go to the YouTube channel and watch it for free. But I taught decoupling in the core content lessons, and the same thing with forex. So if you're watching forex or trading forex, if you're trading like euro dollar or you're trading pound dollar, if you're bullish on pound dollar, you should see in a symmetrical market euro dollar be bullish and dollar be bearish. That's a symmetrical triad. Like you have to have three things in forex. It's not just a one type thing. Like, can you trade profitably with just watching one pair and nothing else? Yes, if you're a price action trader. But to get a full panoramic view of what price is doing and how it should be viewed as high probability or low probability, in forex you want to have a correlated pair, positively correlated, meaning euro dollar is positively correlated to euro dollar. They usually move in sympathy with one another. If one goes up, the other one usually goes up. Not all the time, but generally they do. And if that's occurring, if both are moving up, the dollar index better be moving down. That's a symmetrical market. There are instances where the pound dollar going up, euro dollar going down, and dollar sitting still. And that's going to be a euro pound short because it's a break. Let me make sure I said that right. Dollar sitting still, pound dollar going up, euro dollar going down. Yeah, that's going to be a euro pound short. If the dollar index is consolidating, that means that your crosses without the dollar in them, closely correlated pairs, are going to be paired together, like to make a cross like euro pound. That will make them go up, and the dollar will just sit still. So, in reality, forex is a lot more complicated to teach than index futures. And index futures is a better market to trade because everybody has the same price. You don't get the same tomfoolery with brokers where they can give you a different high, a different low. The spread can widen and take your stop, but everybody else's broker firm didn't get that same price. So you're asking to lose money there. Like you're asking to lose money. So in futures, it's a lot more level playing field. And even though there are some things like we have here today, you're learning the very things that prevents me from showing you these enormous lists of losing trades because I can recognize these things. And it's the logic that repeats in the lectures I've already given out in the core content lessons on this YouTube channel. If you know how you're going to lose money, if you can recognize the conditions that's going to be more difficult than it should be, doesn't it make sense for you not to take trades yet and wait for that movement in your favor where it's obvious? So where it's at right now, that volume imbalance, that should be the end of it. If it's going to go up there, it should be done here and it should start to move up. If not, it's going to break below here, and then we'll start seeing the NASDAQ move in sympathy with that of the Dow. Look at the Dow. It's just staying down on its lows. So whenever you see this decoupling, Every price run, whether you're trading the ES or if you're trading the NASDAQ, I guess for the folks that are just nuts and want to trade the 30-30, if you want to trade this in this indice here, the Dow, look what it's doing. Would you want to trade this when the NASDAQ and the S&P are going up? So I'm kind of giving you the flipped perspective of it. Say you are predominantly a Dow trader. Would you want to be trading this indice if it's doing this against the two higher composite indices, which is the NASDAQ, which uses 100 stocks to make that composite index. And then you have the S&P 500, which uses 500 individual stocks to make up its composite. So if both of those are going higher and this one's going down lower, what does that mean for you as a Dow trader? It's still decoupled, right? So they should be moving in agreement and sympathy one another. They all three should be going up if they're bullish, and all three should be moving down when they're bearish. If there is ever a time when that is not true, like we see here this morning, that is a sit still and wait. You have plenty of time the rest of the day. You have plenty of time. You still have the Powell speech later today, which is inviting this very event here, decoupling. A lot of people don't, there's not a lot of big money movement right now. They're just moving price around. After Powell's done talking, 15 minutes after that, you're going to see very nice, clean price action. But are you willing to wait for that? Most people aren't. Okay, and we overshot that volume imbalances by a little bit into the gap here. So, are you watching any other live streamers besides me? Are they complaining about the ugliness of the price action yet? I'm sitting here sipping some water, smiling, thinking none of this is a surprise. I'm not surprised. Nate Diaz. I ain't surprised, motherfuckers. So, like I said, when it gets down to that volume imbalance, that should have been it. We should have started to rotate higher. If it's going to go up for that buy side, that was the time for it to do so. So far, it's indicating that it could, not that it will yet. I'm more interested in once we get there, once we get into this area here, does it hold? Does it stay there and go higher? Or does it go there, spend a little bit of time, which is reasonable, and then start to break down? Because that means that they went out there to accumulate those buy stops, and now they've unseated anyone that was profitably short, and any movement lower, they're on board with the targets and things I've outlined at the beginning of the pre-market analysis. So far, there's literally nothing in here that I would be long on. Not one thing. Not that there ain't setups there. There are, but there would not be any of them with my money behind it. And you'll get that, and you'll understand that when you can see setups that are on multiple time frames, multi-directional. You can be a buyer and seller in the same day. Just because you can see them there, just because you anticipate them panning out, just because you can frame a stop loss that's reasonable, if it goes against your analysis and you're waiting for your setup, why would you be impulsive and try to do something and prove that you're not patient, that you are impulsive? It goes against the entire grain of what makes a profitable, consistently profitable trader and the mindset that they hold. You have to have control over yourself. You have to have a discipline to stick to. If you've done the work in the analysis, then wait for the setup to come to you. And everything else that's going on outside of that should have absolutely no effect on you. You shouldn't be losing your mind over it. You shouldn't be panicked about it. You shouldn't be, I'm afraid it's going to go the other direction. What if it rallies 250 points? So what? It's Monday. 250 points is nothing. You literally have to stop making every next trade decision the pinnacle of your career. Because when you do that, you're actually creating the exit ramp for your career, or at least for that account. You're probably going to blow it because you're placing too much emphasis on having to do something. I'm watching the bodies in here in respect to this gap. in here. Very, very, very content with being sidelined right now. The chop is real. Oh, he should make t-shirts, man. He could make money on that. He's be making somehow. Look at that. That gap I was telling you there. Boom. And then let's go take a look at the Dow real quick. Pulling up into its gap right there. It's a little smooth, I guess, on the upside, isn't it? They might want to pop that with ES. But you can see how much more complicated. This is a complex market to trade in this morning because you have each indice doing its own thing. And it's real hard to frame low risk in that environment. You can see what it's likely to do, but is it worth putting your money behind it? Not for me. I mean, you're welcome to do what you want to do. Take your wins and go on social media and get your trophies and stuff. But yeah, not me. I'd rather sit here and prove that I have discipline over myself, that I'm going to stick to the tools that I trade and authored, and I'm going to let the setups come to me. And if it runs without me, it's okay. I'm good enough to know that I'm going to be able to find a setup in the afternoon. I'm good enough to know that I can trade that last hour and make whatever I need to make in a job in a month. I can make that in the last hour trading. That's the confidence, but that sounds like arrogance. It sounds like it's bullshit because you all that think that way can't do it. So you think nobody can. And that's not true. And if you just stop thinking critically like that and just try to learn, you can be able to do it too. And you'll think, wow, I used to troll you too, ICT, but now look at this. Good, welcome. All right, so we're inside the new week opening gap here. And it's also consequent encroachment of the opening range gap. That's what that yellow box is. So in a perfect world, it would want to drive into this sell side here. This gap as it was trading up into that. I was telling you, watch that gap right there. And she was very, very useful there. It's very close to the high of that imbalance that's shaded in purple, or whatever shade that closest to purple is here. Now, in that yellow box, what can happen, and I would like to see happen, is for it to drop down, stay inside this red box, come back up and touch the bottom of the yellow box. And if it leaves that volume imbalance, come back up and reprice to that volume imbalance between this candle's here and here. Hit that and then rotate lower. But it may not do that. It may just take off rolling. Either way, it's fine. I told you I wanted to see it go to here, but I'd like to see it use the opening range gap low that this yellow box represents. I don't want to see it deliver like that though. It needs to be a separate candle. In other words, if the candle would have been down here and stopped and created a new candle and trade up to it, any type of return back to a premium array, you want to see it do that. You don't want to look at it on the same candlestick where it moves away from the PD array and comes back to it and same. That's never what you want to see. That's never, ever, ever a point of entry for you to use it like that. It needs to create a new candlestick and trade up into it. Then expect it to roll over. This is what you get by just reaching into these little lows here and back inside the opening range. So let's take a quick look at ES once more. This is the benefit of having multiple screens, by the way, or dividing your screen. But I want to keep one big chart on the screen as I talk. My eyes are a little bit fatigued when I'm done doing these live streams, when we're doing 2 screens and I'm squinting. I gotta protect my eyes. As much as I want to teach it, I still have to take care of my eyes. So imagine you're an ES trader. How you feeling right now? You feel confident? Are you confident about your short? Are you confident about your long? Are you confident that you made the right decision by sitting still? Are you regretting that you did anything yet? Or did you chop yourself up already? Because the market didn't chop you up. You chopped yourself up. Telling you, man, if I would have had someone telling me where the market is going to create these high resistance liquidity runs, how they were going to create these conditions that were going to be problematic to me trading, I would be grateful for that, because I would have been looking for instances um, where I blew my accounts, where I hold on one second. Sorry about that. My wife just got back. The dogs are greeting her. But as I was saying, I would want to see. I want to see someone explain when I was 20 years old how to avoid when the market's hard, because I thought every day was a trading opportunity, and I didn't think that there'd be times where there's not all the advantages that should be afforded to a trader. Like, I thought that I just didn't know enough, and everything that's going on in the price action was an opportunity for someone to take a trade on, and they could be profitable every day. That's the belief I had. And I found that I was losing a lot because I didn't understand these types of conditions where we have decoupling. Now think about what you've learned so far this year. And just in the last 8 weeks, you've learned how to identify high resistance liquidity profiles. You've learned about seek and destroy and how to anticipate them and see what it looks like real time to identify it. You've seen an episode here now with decoupling. And how do we anticipate decoupling? Whenever there's a Fed chair speech, FOMC, those types of things cause decoupling. Everything just unravels. And that's why you have to wait 15 minutes after he's done talking to allow for things to try to get back in sync. And they may not get in sync in the first 15 minutes after he's done talking, but you wait until they do. If you don't see that, you sit on your hands and you don't feel bad about it. You don't regret it. Yes. It gives you a peace of mind. I mean, look at the ES. That's oh, that would make me mad. if I was in that, man, I'd be like, man, come on, what are you doing to me? And NASDAQ is rolling back down outside of the opening range gap. So same thing I was outlining here. I'd like to see it trade down in the lower portion of that pink box, create a new candle without leaving or going below this low here, create a new candlestick, come up and trade up into the low and or the lower quadrant of this yellow box. Because we went back up and did what? Traded back into the new week opening gap, repriced to the volume imbalance right in here between these two candles bodies and here. So the only market that's doing what we would want to see happen in price action is the NASDAQ. You see that? So the symmetry in the market as a whole is broken, but we are able to see price cleaner on this one than we can see it on the Dow and or the ES. That's just as good coming up. Didn't quite get to it. So by it not trading back to the opening range gap low, breaking down like this for the sell side, that's actually weak. That's good. You want to see that. But affording yourself the opportunity to do this very thing here, that's good. And see if we can rush down below these lows and accelerate, not just go below it and come back up into the opening range gap. We don't want to see that. Knowing when to sit still, that is an art that you all should master, because it's these days where you're going to lose money and you won't realize it until after the day ends and you look at it and you're like, man, I wish I would have stopped trading right when I felt like it was getting too hard, or it was getting messy, or you all call it choppy. Now you're learning how to see it real time, so that way you can sit still and behave. Don't act like a fool and get out there and just try to do something because you have time to be in front of the charts. Exercising control over yourself, knowing what you're looking for. If it doesn't come to you, don't do anything. Don't anticipate the setup and enter before the setup is there. Anticipate the setup, and when it comes, then pounce on it. You're not reacting, you're anticipating it. But if the market's presenting opportunities that are far less likely because the symmetry is not there, that means all three indices are doing their independent thing. Well, that's never a market environment where you should be using high risk and or forcing, I got to get into a trade. You don't need to feel that way. Now, again, I don't want to see it just go below these relative equal lows. I don't want to see it go down there a little bit and then come right back up into this yellow box. That's not something I want to see. Oops. 4. Beautiful, isn't it? Beautiful. Looks like a thumb. Useless. There's that gap still in play. Let's see if they want to jump up there and get that little area there. Somewhat of a breaker. I'm telling you, you couldn't pay me extra to trade the Dow. It's just such an ugly index. I can't stand it. I've made money with it, but I've lost more money trading Dow than either of the three indices because of this. It just does some squirrely stuff that I just don't like it. All right, so NASDAQ should get some movement lower. So we're leaving those 3 highs up there in ES. So that bolsters the idea of if NASDAQ can get down to where we were outlining this morning, they might be onboarding longs there and then come up higher later on. Not necessarily today, but later on in the week it might be revisited. So, not bad. The key takeaway, Caleb, so far is we were able to see that gap right there could be used. And we've been framing the idea that we want to see NASDAQ go down, not go up. So we've seen the market trade lower. We had a swing low in here that was pierced there. So you have a shift in market structure. Fair value gap trades up into it beautifully. We were calling the fair value gap before it traded up there. So I said, watch it. So you'll see it in the stream. You'll be able to rewind it. In fact, you probably still should be able to rewind it now, but you shouldn't be rewinding anything while I'm talking because you're going to lose some kind of information that I'm talking about live. But then we delivered nicely off of that. And then we traded down to half of the first presented fair value gap, which is this candlestick here. So in fairness, it looks like this. And again, this is why I don't draw everything on the chart that I'm referring to, because look how much is already on the chart. It makes it complicated if I do it this way, but I have to draw them so that way you can see what my eye is keyed up on. And I'm looking at it in this perspective, but I don't need it to be on the chart. And I'll show you what I mean by that. This candlestick's low, and the down close candle here's high. that is this shaded area here. Okay, so this, I just might as well tuck it in here too. If we're bearish, which was what we've been focusing on for NASDAQ today, we're not interested in being a buyer. It can go up and not have any interest for us. I'm not interested in it. I want to see the sell-off. I want to see the short side of it. So if the first presented fair value gap here at 931, which is the earliest it can form based on what I'm giving Caleb as a model, if I'm bearish, and this is the fair value gap that we're going to focus on, how would this candlestick be used? As an inversion fair value gap. Now, I'm saying it slowly and carefully because I want to make sure that I correct myself because I did something incorrect last week in stream. I said something incorrectly, and then because I heard myself say it and I was live streaming, I kept going back to calling it the same thing incorrectly. And it was based on me drawing on the chart, and it disorients me. So when you're bearish on the market, up close candles that make a fair value gap, which is a buy side imbalance, sell side inefficiency, is going to be a bearish inversion fair value gap. So if we go down like we do here, we went to consequent encroachment of that gap, which let me shade it with the little horizontal thing thingamajiggy in there. Make it bold. So we've been bearish. The market used the fair value gap I outlined before it went into it, trades lower, trades down into and away from, see the orange shaded area here, this box. We left it, came back up, went right to consequent encroachment to the tick, right to the tick. Then it behaves as an inversion fair value gap, lower. If at any time after it delivers on the basis like it's done here, it's reacted and left it and took out a low, that is already done enough to afford it as a properly classified inversion fair value gap. It does not need to trade down the sell side here. It does not need to go down to the target I outlined today. It offered a trade to take out the sell side that would be resting right below that low here. From consequent encroachment to that low, that's a setup. If we ever trade back above and back into this fair value gap and come back down into it, this would be classified as a reclaimed bullish fair value gap because it's an up close candle. That's how you classify it. I made the mistake of calling it an inversion fair value gap last week when it wasn't so. It should have been called a reclaimed bullish fair value gap. So I made a mistake last week in my stream. And it's because I got disoriented by drawing on the chart. I know what I'm looking for. If you go back and listen to what I was describing, you'll hear me describing what I see price do with that range. And I just mislabeled it by the name. But what I was expecting to see price do around it is what was accurate. But I did make a mistake and call it inversion fair value gap when it should have been reclaimed fair value gap. So again, even in a sloppy, disjointed, decoupled market where the ES is doing this and the Dow is doing that, our market, we did pre-market analysis on, and all the PD arrays are delivering. Fair value gap, I told you we were going to consolidate around up in here. Perfect. I told you retail's going to want it to go higher. Well, what am I doing? I'm arm wrestling retail with smart money concepts. Smart money traders are shorting up here, accumulating those positions. Then we have a displacement lower at the fair value gap. We were down here. I told you, watch this fair value gap here. Trades up into it perfectly, drops down. First fair value gap here. It's a buy side imbalance, sell side efficiency when we're bearish, meaning what? It's going to be used as an inversion fair value gap. Once it trades out of it, comes back up, consequent encroachment. You want to see the lower half be used for entries, and once we leave it, the upper half stay untouched. And that's exactly what you're seeing here. And then our market's traded down into sell side liquidity there. So now we take this and we couple it with this low. And we dim this one. It's on your chart still, Caleb. It'll be in the chart, but just I'm not trying to draw too much emphasis on it now. It's just for you to be able to have it in your notes by screenshotting it. Only today's stuff, son. Tomorrow you're gonna have to do your own charts. Okay, so we're going to see this expand down. We don't want to see it come back up into this inefficiency up here. It's in this box shaded area. Opening range gap. We're going to take that out for now. You can see the inversion fair value gap there. And we want to see speed here. Aggressively run down and take that sell side. We don't want to see them be able to pull their orders. You don't need level 2 data for that stuff. You don't need book map. You don't need anything else. You just got to just look at where's price. If you were long from anywhere in here, or you went long up here, but your stop loss is below here, how confident would you be that you're in a good position to still be in the trade, or that you think this is still a bullish market? These are all questions that I think about when I'm watching price when it starts to move towards an old low or an old high. I try to put myself in a position of who was in this trade right now, who was getting long, or maybe would have regretted being long, and maybe they didn't look this and say, hey, this is a good time to buy now. I missed this opportunity, but now they're presenting this. So is that something that they would be wanting to buy into that? I don't know. Yes. Every single time it moves. Okay, Dow. We're almost in that fair value gap. This one's so dirty, it's probably going to want to unsettle these highs up here. So that's more like where I would expect them to take the Dow, because Dow just broke lower rate from the opening. Challenging market today for folks out there that aren't looking at the things I'm teaching you. That's an invitation to show me your trades, by the way, for the folks that like to troll me. Show me your Elliott wave today. show me your knickknacks, your paddywhacks. Give a dog a bone. NQT2024. What are characteristics of high resistance liquidity run profiles? Deeper retracements than you want to see. Targets get traded to later than you want to see them traded to. Smaller inefficiency there. 3 up close candles. Change in state of deliveries, that opening price there. That would be like the last line in the sand for me. I wouldn't want to have anything else go higher than that. Like I said, I don't want to see them come back to that first presented fair value gap. To do that is problematic for being short in the first hour trading. And we are basically technically ending that in 15 seconds. So time together. So in quick summary, I'll try to do this in 1 minute. We looked at how the market presented reasons why I believe that we still could very well be down here. I think that will still be a factor for this week. They left this sell side in place. They went back inside of the new week opening gap, which are these 2 purple dashed lines in here. And we're back inside of the first presented fair value gap. Caleb, you would not use this as your short. Here, yes. There again, no. What is it doing? It's returning back to your point of interest. If it's going back there twice, it's not as good as you want it to be. And you want it to react the first time you get into it and then displace lower. It did go to our sell side. It got close to the next one here, but then said, no, I'm not going there, and started pulling back up. And I told you I did not want to see it return back to the first percent of fair value gap. I didn't want to see it go back to the low of this imbalance here. So because it was going to go here, it's going to go back to the first percent of fair value gap, and or inside what? New week opening gap. So if it's going back there, that's fine. It's going to do so without you. So your trade would be entering here at consequent encroachment of your first percent of fair value gap. That's going to be inversion. Also keying up on the new week opening gap, laying over top of that, and your target would be these relative equal lows. You take a large portion off if you were inclined to have more than one. You don't have more than one contract now, but in your notes, you're going to say this would be first partial or majority of your trade-off. Why? Because you're in a decoupled market. And then your next target would be here, which did not pan out, so you'd be stopped out going back into the first percent of fair value gap. So you're only going to be able to annotate with the basis of this being your profit taken, and you watched as much as this deliver, but that next level didn't give it to you. And it went back to what you heard Dad say, I don't want to see it come back and touch this inefficiencies low here or the first percent of fair value gap again. I don't want to see that. To do that doesn't afford you enough time to trade in that first 1 hour trading. So you have to stick to the rules. Even if this does roll over, you have to have rules, son. You have to have a basis to stick within and say, this is the guidelines I'm staying inside of. If I stay inside these guidelines, you've already seen enough to know that we have rules that tell us when we can avoid very difficult market conditions. And by having that, we are already ahead of everybody else out there. We already are light years ahead of everybody else out there. Everybody else is out there trying to push the button. You're going to wait when it's easy. And you can see it with the rules I'm teaching that it's easy. If it's complicated, if it fits any of the criteria that I've taught you so far about seek and destroy, market is in high resistance, liquidity run profile, and now we have decoupling today. So you can recognize the adversities, so that way you have much more experience by understanding these profiles and how the market's booking price than if you just would have spent 10 years of retail stuff. Because retail won't teach you this stuff. It ain't going to teach you this. No one's teaching this kind of stuff. They're teaching you how to get into trades. I'm teaching you how to avoid when trading in these conditions are less likely to pan out in your favor. That's the key takeaway today, okay? So for everyone else listening, I hope that you found something insightful in this. I hope you learned something of value. We will be back at it again tomorrow. I believe that we will be, I'll probably be doing a 7 o'clock start time tomorrow. And I think that might be the rest of the week's schedule as well. I promise this is the only week that we're going to do it like that, but I want to teach pre-market more in depth. But today I'm satisfied with what I taught. I'm satisfied with how the market has delivered. And I believe that if anyone has a serious mindset about learning, there's huge value in what was shown today, because I could have used this and spared myself dozens of blown accounts in the 90s. I would have literally kept myself out of the very instances where I hurt myself and lost the entire account. It was in these days. I would look at the market, I would see that these things were occurring, but I never saw it as valuable information or intel. I just look at it as, okay, well, I'm in the right market. I'm in the index or the commodity or the currency future that I took a trade on. So I have to stick with it. I know I have all these other things that's scaring me right now, but I'm not going to identify that as a reason to get out and just be content with whatever I have. I held on to it and I arm wrestled the market, and it took it from me. It took the profit I had unrealized, and then it took the entire account because I wanted to arm wrestle it. So you don't have to do those things, son. That's not going to be impressed if you go through the same kind of pain that I went through. That's not what this is about. It's for you to do it better than me, to do it faster than it took me to do it, because I wrestled through all this stuff. you're getting blessed. I feel like the Lord's laying these things out perfectly so that way you get these lessons in the beginning. And that way you can have this understanding right from Jump Street and have it in your mind knowing that there are days when I don't have to trade. And it could still move around with a rhyme and reason that I can still see. That doesn't mean I need to go in there and risk real money. And then when you don't have these types of conditions, because there really isn't anything else now. There is no other reason to stay out of the marketplace. We've already covered all three bases. High resistance liquidity profiles. They're tradable, but you have to handle them differently with a wider stop and hold on to that stop near your entry. Seek and destroy, you can't trade it. And then decoupled markets. You can trade them, but you're probably not going to get your targets. You're going to have similar things like a high resistance liquidity run profile where it's a lot of give and take, but it'll eventually get to where you want it to go. But are you going to be good enough to pick the NASDAQ over the ES? I don't think you will. So to keep that from ever being an issue, I told you to stay with just the NASDAQ. So I'm filtering all of these scenarios because I've taught lots of people all around the world. And for 25 years, I've been teaching. I have picked up on how they make the same mistakes. So by forcing you to just use one instrument, it removes the tendency or the opportunity for you to be tricked by feeling like you picked the right one, so therefore stay with your trade. No, you have to look at all three averages. And if they don't agree, if they're not moving the same way, they're decoupled. If they're decoupled, you're not going to get a perfect price run like you would want in a low resistance liquidity run profile. We don't have that here, but because you've seen all three of the things that cause difficult trading, not impossible trading, difficult trading, anything that doesn't fit the criteria that you've seen in those three different profiles is easy trading. They run right to your targets. Your entries are perfect and pristine. Your stops are easy to place and low risk. And it's just pleasant to trade in those environments. And if I can teach you to focus on that, and anyone else that's listening, if you learn to identify those conditions when it's low resistance liquidity run profiles, your trading will be enjoyable. It will not be stressful. It'll seem like it's effortless. And while there's still inherent risks with that, and you'll still get stopped out once in a while, you're going to find that the market quickly wants to go to where you think it's going to go and where your targets are resting. That's fun. That is what encourages continuous adherence to good sound money management and logic behind the trade setups. So with that, wish you all a very good, pleasant day, and I will touch base with you, I'm sure, with some kind of a review video. And until then, Lord willing, I'll see you tomorrow. Be safe.